So, you've heard people say that, oh, you can get 10%, 12% returns on your investments. And you're like, what? Really? I mean, can you really get a 12% return? And I say, yeah, you invest in mutual funds and, not a problem. And mutual funds, a 12% return on mutual funds, is that even possible? Man, that's crazy, right? Well, the reality is, yeah, you can. There are mutual funds out there that have averaged 12% or better annual returns over the course of their history. You just, you got to know where to look. But before we go there, we got to cover some of the basics about, your average mutual fund return that you might really want to know, right? So, let's talk about where the idea of a 12% average return comes from. So, you can make a 12% return on your investments using a real number that's based on the historical average annual return of the S&P 500. So, the S&P 500 basically it looks at the performance of the stocks from the 500 largest, most stable companies in the New York Stock Exchange. It's pretty much thought of as the most accurate measure of the overall stock market. Okay. Well, the historical average, annual return from 1928 to 2021 has been 11.82%. Now, sure, that's a long look back, and most people aren't interested in what happened in the stock market, you know, almost 100 years ago. Okay, well, let's look at some numbers that, a little bit closer to, you know, home, about a 30-year span. So from 1990 to 2020, the S&P's average was 11.55. From 1985 to 2015, the S&P's average was 12.36. And then from 1980 to 2010, the S&P's average was 12.71. Now remember, that's spread out over 30 years. When you zoom in just a little bit more and you look at that year-to-year returns, now you might freak out a little bit, right? Because the numbers might shoot up really high and then shoot up really low. You don't really know what's going on there. And, you got to keep in mind that you don't want to look at the day to day or year to year. I mean, in 2015, the market's annual return was like 1.3%. But if you wind the clock back 2 years earlier to 2013, right, and you'll find that the market was up 32.15%, right? And even as crazy as 2020 was, the average rate of return ended up only being like 18%. And that's why you can't really, you don't need to get caught up in what happens in a specific year or a specific month, right? As an investor, you have to be ready for one-off bad years and great ones, right? So what you really need to care about is how your investments perform over the span of many, many, many years. And based on the history of the market, 12% is not some magic, unrealistic number. It's a pretty reasonable bet for your long term investments. Okay, well, some people might bring up something called the lost decade, right? What about the lost decade? Are you going to talk about all? Okay. Until 2008, every 10-year period in the S&P 500's history has had an overall positive return. But from 2000 to 2009, the market saw a major terrorist attack, and it saw the 2008 recession, right? And yeah, you guessed it, the S&P 500 reflected those tough times with an average rate of return for 1%, right? And a period of negative returns after that. Now, this is leading to the media calling it the lost decade. But that's only part of the picture. In the 10-year period right before that, from 1990 to 1999, the S&P averaged 19%. Put the 2 decades together, and you get a respectable 10% average annual return. That's why it's so important to have a long-term view and mindset about investing instead of looking at, the average return for each individual year. But that's the past, right? I mean, you want to know what to expect in the future. In investing, we can only base our expectations on how the market has behaved in the past. And the past shows us that each 10-year period of low returns has been followed by a 10-year period of excellent returns, ranging from 13 to 18%. Okay. Well, then, is there something more important than a 12% return? Will your investments make as much as the average mutual fund return? Well, maybe. Maybe not. Or maybe more. We don't have a time machine on hand, so we can't really know for sure. But here's something that we do know. Studies have shown that the single most important factor when it comes to retirement success isn't investing in funds with the highest rate of return, or how your investments are divided, or what your investment fees are. Those factors are all important to a certain point. Sure, sure. But it's your savings rate. The fact that you're actually putting money into your 401k and your IRAs every month. That is most likely to help you have a successful retirement. What's the translation there? Well, it doesn't matter what the average annual rate of return is if you don't put any money into your investments at all. Do you want to have money in retirement? Well, start putting money in your 401ks and IRAs, right? In fact, how much and how often do you save for retirement, right? And how much and how often you do save for retirement is 45 times more important than picking and choosing what to invest in. And yet, some financial experts want to, nitpick over a couple of percentage points on a rate of return and fees. Come on, get real. If you invested 15% of a $50,000 salary from the age of 25 to 65, right, with our 12% annual rate of return, you would have more than $7 million saved up in your retirement account by the time you hit 65. And that's assuming you don't get a single raise over the course of your lifetime, which is very unlikely. But just to be thorough, let's say we're half wrong. Let's say you invested that same amount, but you only got a 6% rate of return. Well, what would happen? Well, sorry to say, but you'd only have $1.2 million saved in your nest egg. Sorry about that. But, don't let some random person on the internet writing a blog, or someone that you know with an opinion keep you from investing. Look at all the facts, gather up all the numbers, talk things over with a financial advisor who can help you make a wise decision based on all the available information. So, how do we go about investing in mutual funds? Well, when you're ready to invest, make sure you're investing. You want to try to get 15% of your gross income into tax advantage retirement accounts. If your company offers a 401k, sign up for it. If they offer a match, please max out whatever their match is. That's a perfect way to kickstart your investment goals. Now, when you start looking at mutual funds, be sure to diversify your investments, right? You could split them all equally or do different percentages based on however you're comfortable and what you're looking for. But, you've got growth and income, aggressive growth, and then international. So do your research and, look for mutual funds that average or exceed 12% long-term growth. That's not hard to find a good number of them to pick from, even with the market today. Now, we know all the numbers, percentages, and weird terms can make investing seem really complicated. But come on, stick with us here. Take your time to learn how to invest. It's worth it. And it's going to pay off in the long run. And you don't have to walk it by yourself. Right? You can find an investment professional and they can help you find the right mix of mutual funds. And you might need an investment pro because the stock market will have its ups and the downs are scary, scary. But don't make knee-jerk reactions, right? Investment pros make knee-jerk reactions by pulling their money out of, their investments. That's exactly what, millions of investors did as the market plunged back in 2008 and during the COVID-19 pandemic of 2020. Now, guess what? Those people who jumped off the investing roller coaster only made their losses permanent. If they'd stuck with their investments like how we're trying to show you here, their value would have risen along with the stock market as the years went on. Tough luck for them. they didn't get to reap the benefits as the market recovered. This is just another reason why you need an investment pro on your side. They can help you keep your cool in those crazy times and focus on the long term. In fact, upping your investments during down markets can actually help drive the big time total return on investments in your portfolio. It's important not to be, scared by the short term or try to take, you know, you've heard this phrase like time the market. Don't try to time the market. Don't try to chase performance. Right? Remember, investing is a marathon. It takes endurance, patience, and willpower, but I promise it's going to pay off in the end. So hopefully you guys, understand, the importance of investing early, don't take your money out. I try to give you guys, a good bit of information to lead you down the right path and still go do your own research, right? You don't have to take my word for it. I'm just trying to provide you with information that helps you make a better decision. But I hope you guys enjoyed the video. If you did, hit that like button. If you're not subscribed to the channel, I'd appreciate it if you did. But until I see you guys in the next one, y'all be safe.